I'm Charlotte McLeod with the Investing News Network, and here today with me is Lobo Tiggre, editor and founder of IndependentSpeculator.com. Thank you so much for being here online with me today. Always great to see you.
Well, it's good to be back. It's like the Chinese curse, I think, a little bit interesting times. So it's a good time to get an update.
It is a really good time to get an update, especially because our last conversation was at PDAC back at the beginning of March, and things have really changed a lot since then. Basically, right after we did that interview is when gold started on its big run upward, and it spent a lot of time above 2,000. We've seen it pull back in the last couple of weeks, but just as we're getting started, you always give us a very realistic view of what's going on. So I thought you could contextualize what's happening with the gold price right now.
Oh, short question, big answer. But I think this is important, and it really, let's stop, pause, think about this for a moment. I know that what the audience would like is for me to say, here's why gold's about to take off, load up, it's time to go, yay. But it's more complicated than that. And first, I should say that when we last spoke, I was saying, the dollar had a good run. There was reason to believe that the dollar would go down. And at the time, gold was still seemingly trading primarily off the DXY, the dollar index. And that pretty much worked out. And we went on to these highs and we stayed up over $2,000. But that has become unraveled. And, there are days where gold trades like a Rorschach image to gold and the DXY completely. And there's days where gold and the dollar are going up together. And it's not because there's a new war or something, it's something else. There's days where it really seems like the 10-year, the US 10-year benchmark rate is really what's driving gold. And days they seem just like all three will go up at once sometimes. So I'm not helping your audience here. I'm not clarifying anything here, but maybe that's actually a good starting point. Whatever you think whatever you're sure explains everything. This is a time to not be quite so arrogant about that. Take a step back, take a deep breath, at least in the near term. I mean, bigger picture, yes, all the money printing, recession, all that stuff. But right now, the whole market has gotten quite chaotic. And I think, I don't want to go down the political rabbit hole, but I think that has a fair amount immediately, as you and I are speaking, to do with the whole debt ceiling circus. That's an outlier type event. Like most people, I think it will be resolved one way or the other in the very near term. But while that question mark is in the air, there's times where we see news that normally would be bad for the markets, like good news for Main Street, bad news for Wall Street. But there's encouraging news about the debt ceiling at the same time. So Wall Street goes up. So I'm not sure exactly where you want to go, but you asked what's going on. And the most important starting point there is what's going on is chaos. And this is a time to be careful. Into that chaos, I have done some research, and if you want, we can go there next. But there's a particular variable that you and I have heard our good friend Rick Roll and others in the business say for many years, that real interest rates are not the only, but the most powerful, the main driver for gold prices over the years. And I have seen this before myself. I have said it probably on your show before myself. It's not just the conventional wisdom, it's a relationship that's been measured in the past. But I have to confess, Charlotte, that I haven't measured it recently until just now. So this is breaking news. INN gets the scoop here amongst the media networks. I've just put out this research and I've looked at it, and funny thing happens when you look at it. First, you have to ask, well, real rates. Well, which real rate? You adjust the 10-year for inflation? Do you adjust the Fed funds rate? They're different. And so long story short, what I have found is actually that the long-standing relationship between real rates and gold seems to have come unglued, and not just today or in the current chaos, but over the recent years. And there was a stronger case to be made back in the 70s and 80s in that big gold cycle. So I understand why my mentors taught me this. And then you had this nuclear winter of, the 90s and the aughts, and nothing changed. But actually, since then, a lot seems to have changed. And I won't get too nerdy here, but there's a free article on the website right now at independentspeculator.com questioning the conventional wisdom. Is it wrong? And I'd like to be able to say, okay, so real rates are out. Here's the new variable. Follow this and you'll make a fortune. Unfortunately, real life is not so simple. We did find that over the long haul, actually the nominal 10-year benchmark rate is more highly correlated with gold. Since 71 to present, it's now more correlated than any of the real rates we looked at. And, quite shockingly, the 2-year also is even more highly correlated, but there's less time on that. And if you think about it, it kind of makes sense. I mean, how do you get real rates? You take some other rate and you subtract inflation from it. But our bond rates, the interest rates, we get those moment to moment. They're electronically tracked second to second. We have information in almost real time on those rates. But inflation's only updated once a month. So you're subtracting the same number all month long until you get the new inflation number. That means for all, 29 out of 30 days, it'll be the nominal rate that's wiggling what we are thinking of as real rates. So I promise not to get too nerdy. I do recommend the article for anybody interested. But this fits with my opening answer to your question is chaos. What we thought we knew may no longer be so. At the moment, it seems like nominal rates are a more powerful explanatory variable, but we're still seeing plenty of times where the DXY, the takeaway is be very careful of your assumptions right now. Now, if you want me to make a bullish case, it's not going to be ironclad. Here's the data. This proves that here's where we go. Be more macro. But right now, I hate to say it. People want to hear rah, rah, rah. Here's why we have to buy. But that's not my message today. My message today is one of caution.
Well, and this is exactly, we don't bring you on to hear the rah, rah, rah. We bring you on to hear about really what we should be doing right now.
As always.
As always, but it's what we come to expect. And I think this is a great place to start this chaos in the market and throwing out things that you thought were true. So just going back to your research, which I do recommend everybody take a look at, it helps to go through it. You've got all the charts laid out, and that's helpful in understanding some of the nerdier things that you're going over here. I think a question that I have is, so what made you decide we need to take a look at this concept that we've heard about from so many people that is really well entrenched in the industry?
Well, I was doing one of my weekly updates, and I was looking at the markets, and I was this is going to sound even scarier, Charlotte, but the truth is, as we've been saying, we've heard from our mentors in this business for so long that real rates are so important. And that was great news because real rates for a long time have been negative. The Fed nailed the nominal rate to the floor and inflation was low, and then things went negative and they stayed there. So as long as real rates were negative, we could shrug off, whatever other news might happen, or even a strong dollar or these other things. But just as of the last CPI and PCE reports, the core rates have gone negative, and that's what the Fed says it's looking at. And on a PCE basis, even the headline rates are negative. So, are now positive. They were negative. They just flipped to positive. So this one thing that we were reassured for so long meant we didn't have to worry about gold. Suddenly, that accepted signal says, well, it's time to worry about gold. So I went to look at it, and I found a lot of noise. I was trying to look at real rates. They've gone positive. So what's the correlation look like? And really this year, since real rates have been climbing, guess what? Gold was climbing at the same time. And until just the last couple of weeks when, gold went back, pulled back from 2000, we had real rates and gold going up together. So of course I have to say, well, what's that? They're not supposed to do that. They're not supposed to go up together. They're supposed to be opposite, X on the chart. So I started looking farther back, and the noisier the real rates looked, they didn't seem to be inversely correlated. So I pulled back and looked at the big picture. The biggest relevant picture is August of 1971 to present, because that's when gold was freed to trade on the open markets, or you could look at it that way, or that's when the dollar became a worthless abstraction. But anyway, and then I looked at it, and just by I was looking at different real rates, and then just by comparison, what's the difference between the nominal rates? And I started looking, and the nominal charts looked better or more explanatory in many cases. So we started running the numbers, and it turns out that, yeah, now, right, I don't know when the last time somebody really dug into this, but I can tell you it was around 2004 in my case. I'm embarrassed to admit it. But the numbers say something quite different in almost 20 years. Uh, so, so the single most explanatory variable in that period we could find was actually the nominal 10-year benchmark rate. And what made me think about it was just, well, if real rates have gone positive, we need to ask ourselves, what does this mean for gold? So the bad news is what we thought we knew may no longer be so. The good news is, well, if real rates just went positive, but the nominal rates are more explanatory, well, maybe that's a good thing, because we still have negative rates on a nominal basis, at least for CPI. So that's a helper there.
All right. Well, we're still learning. And I have to ask you, you put this out, this came out midway through the week. It's been online. You can go find it. Have you had anybody,
Yes, it's
because
not
as
my
we've
fault
been,
gold prices went down.
yes, but yeah, so as we've been talking about, this is a well-entrenched concept. Have you had anyone come forward with thoughts on your new research? Anybody saying that makes sense, it doesn't make sense? What has the response been?
Yeah, I think, frankly, the response has been quite surprisingly muted. I expected some fireworks or somebody to come storming back with, here's my chart, here's why you're wrong, and I got nothing. I've got a few people said, yeah, I've seen something similar, or I've given up looking at rates, or it's all about the dollar now. But the dollar wrecking ball. But yeah, I when I posted it online, I did the research internally first, and I thought there must be something wrong, and I sought feedback, couldn't get any contradictions, so I put it out to the Twitterverse, and I put it out there as it's a question mark. The name of the article is, conventional wisdom might be wrong, not this is wrong, right? And I invited people, tell me why I'm wrong, show me what I'm missing here. And I don't know how many. I have 24,000 followers, and not one yet has been able to step forward and say why you're wrong. So we'll see. I think it'd be very interesting if somebody could show me what I've missed. But for now, the numbers are what they are. And by the way, we threw the book at it. We looked at LIBOR. We looked at Fed funds 2 months, 1 month, 1 year, 10 year. We looked at everything. I mean, 30 years kind of silly, but and the numbers that we found said that over the longer term now, the nominal rate is more highly correlated than the real rates. Pick your real rate.
All right, so we'll put it out to our YouTube audience as well, see if anybody comes forward with thoughts. Speaking of factors that are important for gold, I think we need to touch on the Fed. So recently we got the latest minutes, which seem to show that the officials are a little bit divided on what may happen in June. We also got recently the latest PCE price index data. The Fed looks at other points as well. So I'm hoping you can help us unpack what we might see from the Fed at the June meeting that's coming up pretty quickly.
Well, I will answer your question since you asked so nicely, but I should always remind the audience that I'm not a professional economist, which might be a good thing, but I'm a due diligence guy. I'm the guy that Doug Casey hired for all those years to go kick rocks and help improve stories. But people want to know what I think, and I do have to make my own calls, so I do think about these things. But I like to remind people, I'm not the guru that pretends to know what the Fed will do or to tell you what they must do. That's just not me. The PCE number, I mean, that's not a shocker to me. I've been saying inflation was going to be sticky, higher for longer. Not rates, but the inflation was going to be higher for longer. I've been calling for stagflation, as you know. So this fits with my view, but the mainstream has been expecting it to go down. I understand why the market odds on a rate hike for June are now, I think, up over 60%, whereas they had been as low as 15% just a couple weeks ago. So there's been, sort of team soft landing news out there that says, oh, yeah, things aren't so bad. That said, I think we also have plenty of data that says, yes, things really are bad. I mean, the yield curve itself is absolutely insane. There's like 200 basis points between the 1 month and the 10-year. And okay, granted, the nearest term is highly influenced by this whole debt ceiling circus. But even without that, the massive inversion of the curve, that has never happened without a recession. And people say, oh, well, it takes time. Well, yeah, but it started inverting 2 years ago. And we did have those 2 quarters of negative GDP. And we do have all this news of layoffs. And we do have the leading economic indicators, a whole set of them, the LEI that we talk about, the leading economic index. No, that's down for the 13th month in a row. And I could go on and on. I think the audience doesn't need me to rehash all the bad news. We're all well aware of it. Bad news sells, right? If it bleeds, it leads. Sorry, no offense to any professional journalist here. But and the one-legged stool that they keep hanging everything on is, oh, but look how strong the labor market is and the consumer is. Those are the most lagging indicators, and everybody knows that. Everybody, even the mainstream guys and gals, they'll say that's a lagging indicator, but it's so strong, and they just keep, they just dismiss the whole reason why they shouldn't dismiss it. It makes no sense, but that's what's happening, and I understand that. You look at the revised GDP numbers, doesn't look so bad. It's easy. I can see where, and when you look at the stock market, you can see where people say, well, Lobo, you've been the little boy who cries wolf, which is really undignified for a Lobo. You keep saying there's going to be a recession and it doesn't show up. I'm not so sure. I think we have a masked recession. I think the labor hoarding post-COVID has masked weakness. I mean, it basically, apart from the labor market and thereby the consumer spending, which has its other red lights, I'm getting distracted from myself, but like the credit card charges and all that stuff, like the consumer is not as healthy as people want to believe. And by the way, retail sales were a number in my favor on this last batch. So I don't think I'm the little boy who cried wolf. We will know whether I'm right or wrong very soon, because I'm not just saying someday or this is my big macro theory. I'm saying this year. I'm saying we're actually already in a recession, and that will become undeniable before the end of this year. So in the next quarter or two, I'll either be right or flat out wrong, Charlotte. I think I'll be right. I don't think any of the data that we've seen since then, including, a hot PCE number, contradicts that in any way. That's a conventional assumption that, oh, if inflation is up, then that must mean the economy is booming. That's what causes inflation in a hot economy, right? That is not true. Ask Zimbabwe, right? There are other things that can cause inflation besides a hot economy. So I'm sticking to my guns here. And for anybody who's been pulling his hair out or her hair out, waiting for, the great pumpkin to arrive, I'm not going to be like this all the time. I'm not coming back every year like Linus to the pumpkin patch. I have uncharacteristically, if not made a flat-out prediction, I've made a call for this year, and I will admit that I'm wrong if I'm not shown right in the months ahead.
Well, and definitely we will find out quite soon. And when it comes to recession, we do also have, even the Fed has conceded, maybe we will see a mild recession this year. What I thought was a little bit interesting about that is that they seem to blame it on the banking crisis versus any of the other issues that we've been talking about for so long. So maybe we can also talk a little bit about the banking crisis, which is another topic that kind of erupted right after that last conversation we had. What are your thoughts on that? I would appreciate, again, the level-headed view on whether we've seen the last of that.
Well, yeah, I know there's some people out there saying, oh, well, just wait, there's more banks about to go boom. That could happen. When you go from 0 to 5% interest rates almost overnight by central bank standards, things do break. So, I didn't know that would be the particular thing that broke first in the U.S., but it's in no way surprising that it did. And I can see the case for more pain. However, my own expectation would probably be not more banks. It'll be something else. Because don't forget, it wasn't just that they, stepped in for these particular banks or Janet Yellen corralled Jamie Dimon and crew to step up with 30 million or billion. But it was really, I think, the Fed when they stepped forward with I forget the name of this particular program, but they stepped forward to take this debt that was underwater that the banks held as assets, that because of the higher rates that these bonds were underwater, and the Fed stepped forward to lend back at par, to honor that at par, or to provide liquidity at par for these underwater bonds. That was the issue that took Silicon Valley Bank down and threatened these others. And so, and that wasn't just one bank specific, this was countrywide. So this was a really big deal. They keep saying, oh, it's not a crisis, it's just a idiosyncratic, a few banks, and just for safety, But what they did was a crisis level response that was blanket for the whole country. And it was so big, hundreds of billions of dollars, that it reversed the QT they were doing for a long time and has mitigated that now. And it's still being drawn on. That's still ongoing. Billions and billions of dollars, as you and I speak, being provided in liquidity to banks via this facility now. This was a big deal. So when you have the Fed backstopping the banks, lender of last resorts, which ironically was actually one of the original things it was supposedly intended to do, with that happening, I'm less worried about banks. But I think the same starting point of you cannot increase interest rates at such a record pace. And it's a world of difference. People will talk about, well, Volcker increased rates from 15% to 20%, right? And it helped, it cured inflation. Well, from 15 to 20% is a 33% increase. From 0 to 5, it's not just 5%. It's like mathematically infinite, the increase almost. I mean, it is a much bigger shock. And on top of that, you had more normal rates before, Volcker stepped in with a sledgehammer. And here we had like absurdly low rates for such a long time. I mean, the era of free money. And you'll see even mainstream talking heads will talk about, oh, the era of free money is over. And it's almost like they don't believe themselves. They say that, but everything's fine. I don't think everything, you cannot have an end of an era without pain, Charlotte. So without going too long, all I'm saying is, I didn't know it was going to be that liquidity issue with the banks. And I don't know what the next shoe to drop is. But everything I think I know about economics and everything that I've studied about history tells me that, never mind the June meeting, what the Fed has already done has broken some things, will break more things, and there will be more pain. So what happens next? I guess I never answered your question about the June meeting. If you stuck my feet to the fire, I think they probably will pause. So they're trying to brand it as the skip now, right? That's the latest buzzword. It's not a real pause. It's not, we're done here. We're not done. We're not done. Oh, we still got more work to do. But if we just skip this meeting and then might raise more later, then it's not a pause. We're still raising rates, just not this time, right? I think that's the messaging we're getting. And you need some hawks to come out and talk about, yeah, we got to raise rates. And then you need some other people to come out and say, well, maybe not, and test the waters, see how that goes. I think this is what, in reading the tea leaves here, I think this is what we're getting by signal is they don't want to say pause because they don't want the markets to go crazy and reverse their work. Throwing people out of work is their work. But anyway, so that would be my base case right now, unless some things come out much harder, like if the labor reports, non-farm payrolls, we get one more of those before the Fed meeting. If that comes out super hot, then yeah, I think they probably will go one more time. But even with PCE right now, I think they're still probably likely to do a skip. And then my guess would be there'll be enough weakness after that the skip turns into the pause. Like they say they're going to skip. It's a way of easing into it without sending the markets going. So then that's right now. The next shoe to drop, I don't know what it is, but I think there will be. And I do think the Fed pivots before the end of the year, not because they've beaten inflation, not because everything's cooled off and they don't need rates to be so high, but because they've broken something else. And even Powell has said that if systemic risk comes up, that is a reason for them to pivot. So that's not the sort of thing I can say, here's what it is and here's the date it's arriving, Charlotte. But if we were talking black swans, there's so many of the bloody things swarming around that I think we should be anything but surprised when one comes in for a landing. And I think that happens probably in the next few months. I'll be surprised if it's actually towards the end of this year. I think it happens over the course of the summer.
Okay, so I think we can know at this point the short term is looking hazy and chaotic. Long term looks a little bit more clear. And I know that for you in the long term, if we
Let's
put all
not
these,
pussyfoot
oh,
around here. So
okay,
let me
okay.
jump in. Not a little bit more clear. I think the mid to longer term is very clear. I think the Fed is stuck between a rock and a hard place. We've said that for a long time. This is crunch time. This is happening now. They have no good choices. They know it. And I think anybody, even in mainstream media, who's honest, you'll hear them talking about what a tough job the Fed has, right? This is happening now. You know, this is my mantra. Forget about inevitable. Forget about even imminent. I want happening. This is happening now. This is crunch time now. This is why I'm willing to put this forward. So, I hate it. You have these talking heads from these funds. They come, well, maybe we should be a little cautious about risk. They're not helping me with a little bit cautious. Make a call or don't. So I've made a call here, Charlotte.
Okay, appreciate that
So
clarification. And I
pet peeve.
always like it when, no, it's good. I always like it when we can get something solid out for you. And I know that gold and silver are in your right now basket. What I want to talk about, so we know that we're going there. We're going there for gold and silver. I think maybe when investors look at their portfolios of gold and silver stocks, especially on the junior end, they might feel like this is not really happening right now. So wanted to check in with you on that and see what we can tell people who are having that feeling and wondering, okay, when are my stocks actually going to move? Especially because gold price is actually still quite historically high. Silver price is doing all right. So what are your thoughts?
Yeah, I'm definitely feeling this. Interestingly enough, not so much from my clients, but from the social media, from the Twitterverse out there, definitely getting a lot of pushback on this. People are impatient, and Rick is just so quotable. I do listen to other people, but Rick is so quotable. Like he likes to say, if your investment time horizon doesn't exceed a long weekend, maybe resource speculation isn't for you, right? He says these things. And I don't want to be quite so clever about it, but I do think that is, the basic idea is right. I mean, Mr. Market doesn't care what you or I think. It doesn't care what we want. It doesn't care how desperate we are or how impatient we are. Impatience, any kind of emotionality over logic, is a risk to any speculator. You have to have discipline. And if your basis for speculation hasn't changed, then the price action or inaction is at best one data point, right? If maybe you've missed something and the price is telling you that you've missed something, that is worth paying attention to. I'm not saying ignore price. But if you do pay attention to it, you look at it again, you ask others, you ask people who disagree with you, show me why I'm wrong, and your case is still there, which is the case for me in gold and silver right now. Silver maybe lags a little because of its industrial side, but it's still a monetary metal, and gold and silver are in my shopping basket right now. And if I look at it again, and my basis for speculation hasn't changed, then I have to set aside that price. And however angsty it makes me feel, and I'm not saying I'm a robot and I don't feel these things, I do. It's annoying, but I don't let that make my decision. And I don't want to come across as condescending or insulting, but you kind of have to buck up on these things. If you can't handle the heat, you really shouldn't be a speculator. Maybe just buy a gold ETF or something and ride the metal itself and don't worry about the stocks. But if you do that, maybe you'll sleep better. Maybe that's better for you. But if you want to make money, you will be leaving a lot of money on the table, because the leverage that the stocks offer to the underlying commodities is legendary. Unless the entire world has changed when we didn't look, Charlotte, I do think that we will see payday. And I just think it doesn't make sense to be impatient. And if anything, if we have capitulation because people are just so disgusted with the stocks, gold's up, my stocks are down, and people just decide to sell, or the fair weather friends, the momentum chasers, just get out. Anybody who bought when gold hit that nominal all-time high, and then now they're disappointed because it's corrected, I think the disciplined speculator will take shares off those weaker hands, and especially if you get it, if you're with the program, but you're late to it, I think at times like this are a godsend when the actual value case is higher, plus or minus $2,000, that's a terrific gold price. And if the stocks are on sale because of sentiment, market sentiment, that's absolutely an opportunity in my view, Charlotte.
Okay, so usually we hear it's not healthy to suppress our emotions. Maybe when it comes to speculating,
I didn't
we
say
can go
suppress.
ahead.
I said don't make decisions based on it. That could be a long conversation. But no, I actually, just real quick, emotions are data. If you're nervous about something, it's telling you something. There's something not nailed down in your premise. So I don't think you should suppress or ignore emotions at all. But you don't use an emotion to build a bridge. You don't say, oh, I feel this beam ought to be, 3/4 inch steel. There are calculations, there are measurements. You know how thick that beam needs to be to build that bridge. So you use your emotions to gather data, tell you what's going on. You use your intellect, your reasoning capacity to decide what to do about it.
So we've gone through quite a bit to do with gold. I just want to check in quickly and see, we've talked about all these big factors. Is there anything that we didn't go over that you want investors to pay attention to when it comes to gold?
Well, all my talk of chaos may have left people keep feeling fuzzy about where we go from here. So yeah, let's be quite clear. Whatever variables you're looking at, whatever you think might be, driving gold today, I think basically we set that aside. We look at the macro, and the macro, I think, is we're headed for recession. That's very bullish for safe haven assets, which includes gold and silver. And if the U.S. goes into recession and the Fed reverses before the ECB does, that is also bearish dollar, bullish alternatives. That doesn't have to happen, but if it does, it gives us a good tailwind. So quite clearly, gold and silver. And then the only thing about silver is, it's not that I'm not bullish on silver, but I just want people to understand that silver characteristically in a bull market lags gold anyway, and then catches up at the end. And all I'm saying is it may do that even more so this time because it has this stronger than ever industrial component. On the flip side, though, the same outlook means that we really want to be cautious about anything to do with industrial metals or minerals. So that includes oil. Like there was this big hope that China reopening was going to send energy prices and commodities prices soaring. Didn't happen. It helped oil more than anything else, but it didn't really happen. So if I'm right about a deepening global recession and China is not going to save us, excuse me, that really tells us to be cautious about anything industrial. I'll try to wet my whistle again. The universe is telling us we should wrap up. All right. Try to say this as few words as possible. So the macro says no copper, no lithium, no matter how much demand we see going forward, no oil. I'm very bullish on oil because the ESG crowd is just starving that industry of capital, even though we're not done with oil yet. So, even the most exciting ones with the strongest cases going forward, not in front of the recession. I want to see the recession do its worst, or the worst be priced in. When the recession denying needs to go away before those commodities really get whacked, and that's when I'll be looking to buy. As a contrarian, as a bottom feeder, I want to see capitulation on the broader markets because I think that will whack everything industrial, with the one exception being, of course, uranium, which is baseload power. Unlike copper or oil, uranium is having a great year. And even better, we were talking about, gold bugs maybe not being in capitulation yet, but seeming close, pulling their hair out. I think it's with uranium bugs, they're there. I'm hearing from uranium bugs left and right. And I'm sick of this. The metal is going up and my stocks keep going down and all that. I see that as an opportunity. To anybody with the guts to be a contrarian, I'm not saying uranium stocks can't go down, especially if there's a market crash or something. Stocks are stocks. But that only lasts so long. And I think for reasons we've discussed before, only more so now, I'm extremely bullish on uranium, not some when, this year. This is happening now. The long-term contracts that underpin the higher prices are happening now. We see it dragging spot prices higher, even though the broader markets are weak and the energy sector is weak. And I think that will translate to significant gains for uranium bugs by the end of this year.
Okay, so if they can hold on, we will get there. And I think we can wrap up there. We've destroyed your voice, and I think we can wrap it up and let you go. But thank you so much for coming on to go through everything. I know I told you before we started the camera, this one would be a lot about gold, precious metals. We'll come back a different time and we'll go into uranium a little bit more deeply, because I know that everybody likes to hear about that from you. But thank you again for being here to tell us what's going on.
Thank you, Charlotte. Always a pleasure.
Of course. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Lobo Tiggre at theindependenspeculator.com.